So here we go. All right. So I think we have a few more people that are probably going to jump in. I'll go ahead and start and get through kind of some of the high-level pieces. By the time I get through that, I figure the others will have jumped on. So good morning, and thanks for attending. Hope you're eager as I am to learn more about financing options for government contractors. Just a quick note, this webinar is for providing ideas and resources, but not specific guidance or recommendations for you or your unique business situations, excuse me. When I bring speakers on to these events, generally speaking, they're more than happy to engage with you or your company as part of your advising team in his or her individual discipline. So Matt, who's here with me today, will have contact information. You'll have his as well. So if you have questions, you can certainly reach out directly. If you want to get really detailed and be general on this, that's fine. You can reach out to him separately to get really detailed and ask specific questions. He's happy to engage. So we don't have a chat feature on my platform, so we'll just use the Q&A feature. And if there's a need for kind of more in-depth, I can always promote you to a speaker so that if you ask a question, I can always have, if Matt wants to talk with you to get clarification and understanding, he can certainly do that. So we'll jump right in. I'm going to do a couple of intros, myself and then Matt, and we'll be done on time by noon. So my name is Brian Klickener. I'm with Risk Strategies. I have over 20 years of experience in business development, sales, account management, and operations across various industries, to include where I started in retail, government contracting, and then most extensively in the insurance business. Risk Strategies has over 1,800 employees and 70 offices. I would actually say we probably have over 1,800 offices now, since we're all remote. Here at Risk Strategies, my team and I work with clients to create bespoke employee benefits programs. To that point, a common statement that we hear from our clients is, you guys don't talk like other people do that do what you do. We take that as a compliment, and we're happy to discuss our different way of addressing health insurance and benefits. Those programs are likely your second or third largest business expense. Also, I do a ton of webinars. There's 12 so far this year, with another 6 scheduled in the next 8 weeks or so, with more to come after that. So today, my friend Matt kicks off this GovCon series, which will include future sessions on OTAs and CMMC. So Matt Stavish, Matt is the Vice President of Republic Capital Access. RCA is the largest and fastest growing specialty finance company for government contractors, providing a suite of solutions designed to help contractors grow their business. At RCA, Matt has aided startups to publicly traded organizations in achieving financial solutions to a variety of challenges posed to businesses operating in the federal sector. Matt holds an MBA in finance and innovation entrepreneurship from Northwestern University's School of Business. He also is an avid barbecuer or smoker. I think smoker is the better term. So I don't know that we're going to get tips on how to smoke ribs or pork today, but certainly if you want to get engaged with him one-on-one, he has an extensive knowledge and is helping kind of bring me along slowly in that as well. So with that, I'll pass the mic to Matt to get things rolling.
Thank you, Brian. All right, so we're going to share the screen here. Should make sure this works, everybody. All right, and as Brian said on the Q&A feature, put your questions in there, and want to make sure that everybody gets all of your questions answered. That were to pop up. Brian also has my cell phone, so he can, if there's a question that pops up and I don't see it, he can text me. But this is access to growth capital for government contractors, and this particular time of year is really exciting for GovCons, because there's a lot of contracts that are awarded to create a lot of interesting financing challenges. So we're kind of going to go through the options that are out there, the pluses and minuses, somewhat in depth. But the goal would be for any of the participants is you kind of have a better roadmap of the market and where you would best spend your time in finding these options that are out there. All right, so and there's my contact information. So like I said, if you guys want to reach out to me over email, that's my office phone number. Just shoot me a note and I'll give you my email signature, and call me on my cell phone too. We're located in Herndon. So this is the financing market, and this is what we're going to be going through. And I think this is a good starting place to start talking about financing, because typically when I talk to a company, the first thing that most firms are looking at obtaining, and for a lot of the correct reasons, is bank financing. And if you look over on our y-axis, bank financing is the second hardest type of funds to obtain, but it is the cheapest. And if you look at statistically, most companies are not going to be getting financing from a bank, even government contractors. Most companies are actually going to fall into the non-bank financing bubble market, which is going to be much easier to obtain, but a little bit more than bank financing. But we'll go through all these. We're going to focus on bank, non-bank, and then I will touch on MCAs because that is an issue and does pop up, mezzanine, equity, and R&D grants. I'll just touch on those in that space. So it's important to understand which all these types of financing are on the left, how it impacts your balance sheet and personally, because some of these will affect you more personally than others. So if we look at, say, this is your typical balance sheet. You got your current assets, and then you have your liabilities and equity in the lighter green color. And then you have your equity portions. So that's our typical balance sheet. And our bank is going to look at your equity that you have in the company, and they're going to give you something more like a line of credit. So that's in that light green box. And then they're going to let you borrow from that against your receivables. So this is typically how a bank works. The reason why we have equity highlighted is that banks are looking for operating history, profitability, and that profitability would be then shown in equity. And because you have equity, they'll give you some sort of loan against your receivables, generally speaking. In the non-bank space, similarly, you're going to have a loan or line of credit against your receivables. But notice how we're not highlighting the equity. So you're kind of able to bypass that one requirement. Then there's another type of bank financing, which we're going to talk a little bit about, where you don't have any liability and you just turn your AR into cash. And that actually is the cheapest form of non-bank financing in the market. Then you have mezzanine financing, which is very much tied to your equity. And that's going to be a long-term debt. Those are going to be for bigger companies. And warrants, we'll talk a little bit about that just to make sure. A lot of financing is nomenclature, understanding what words mean, but yeah, there's some warrants in there. And then you have MCA loans, which is, if you're searching for financing on the internet is what you'll find. And they'll give you a long-term or a short-term, long-term loan, 18, 36 months maybe, and you'll get cash. Those will be very expensive, think credit card rates. And then you have equity. So this would be like a private equity firm giving you a minority or majority interest in the company and giving you equity dollars. So those are kind of the general places where they play, and some merge into other areas, but generally that's where your types of financing for most government contractors will fall. So let's talk a little bit about bank financing, what the banks are looking. Now the bank markets are in flux, to say the least, thanks to COVID-19. Some bigger banks are having a little bit more tighter restrictions on getting money out the door. Smaller community banks are a little bit more aggressive than they were previously. But banks, and this is kind of generally and mostly understood, but depending on where people are in their business's life cycle, there's going to be the lowest rates. There's going to be strict underwriting and covenants. They're going to want to see a financial and accounting system and a financial reporting system that is pretty sturdy. And then they're going to focus on what are typically called the 5 C's of underwriting, which is cash flow, collateral, capacity to pay back, character, and credit. It's your kind of banker 101. When you wake up in the morning and you want to be a banker, you think about the 5 C's of credit. So this dives in a little bit deeper to what the banks are looking for. So when the bank talks about cash flow, what they're really talking about, do you have a debt service coverage ratio of 1.25 or to 1.3 times? And what that means is if you make $1.25, they'll loan you $1. And that's the bare minimum. They would really like that number to be bigger, but a minimum of a debt service coverage ratio of 1.25 to 1.35. And they're going to look for last 3 years financials, your year to date, and then at times future projections. And so that really comes into play for your company. Have you been around long enough to get those 3 years financials or the projections that the bank could work with and feel solid with? And then they want to know is, does the borrower have sufficient collateral to back up the loan? So you got to think, if for a banker or anyone in credit, if everything goes badly, can you be paid back? So what's the collateral of the borrower? Personal guarantee would be the other way of saying it. And that's where you get into loans on homes and deeds and that sorts of things. And then capacity. So do you have about 10% of your total and personal debt in reserve? So this is, think about a mortgage. And then character, you know, do you have you done this before? Is this a business that you should have experience in running and being successful? You know, Brian mentioned I love cooking and, you know, smoking food on my green egg. Do I have the experience to run a barbecue restaurant? Absolutely not. So, you know, but if you worked at Lockheed Martin and you're going to go back and work for the same contract and they're going to go back, like, yeah, you probably do. And then credit, you know, your personal credit is tied to it. Banks are going to look for a minimum personal credit because it's a personal guarantee. Now, when your company gets to 100 million in annual revenues, you can probably get that dropped. But for the most part, starting off, that's going to be a big piece of it. So non-bank financing, we're going to spend more time here because statistically, most folks are going to play in the non-bank financing market. And this is where my firm plays. I'm going to speak generally, not specific to what we do, but this is where the challenges that are going to pop up for government contractors, because everyone, when you get the contractor, you can go to the bank. And then when the bank says no, and if two banks say no, generally I would tell folks, if you've been told no by two banks, it's you, not them. And that's okay. You'll be ready for a bank, but just not now. So then you're into the non-bank space. And what does that look like? Because this is the non-regulated space. So there's generally two types of non-bank financing sources out there. On the left side, which we'll dive into, you have factoring, which is the true sale of AR, which is non-recourse and no personal guarantees, no liens, no covenants. And on the other side, you have asset-based lending, which sometimes comes across as factoring, but as recourse, personal guarantees, liens, and a higher rate. Now, what's interesting in the market is how these two terms have been badly merged together and intertwined to be a little bit confusing for you, the consumer business owner. So let's talk about those terms. So a good place is soda. So my dad worked for Pepsi growing up. And if you live in Pittsburgh, where we lived for a period of time, and you go to a restaurant and you ask for a soda is a Pepsi or a Coke. That's pretty definitive. Everyone understands what that means. But if you go to, say, Georgia, where Coke is based out of, a Coke is a Coke or a Pepsi. So we have a definition issue. And that is the same thing with factoring and asset-based lending. Asset-based lending is a lien against your asset. So it's a loan against your receivable. So it's a loan to a company, typically a company that's credit quality is, you may not be bankable yet. That's how they generate it. So that's because it's a loan, that's why you get the personal guarantees and the liens. It's just like the example we showed before. It's like bank financing, except much more expensive. Factoring is actually purchasing your invoice off your balance sheet, turning your AR into cash. So the underwriting is not on your company because there's no loan. It's actually on the federal government or say CACI or Lockheed Martin taking their credit risk. So typically the rates are much lower. You have a reduced day sales outstanding and it reduces your leverage in your firm. Now, so there's no balance on the line of credit, as we can see in the orange box. So the tenets of factoring would be non-recourse and no PGs and no liens and no covenants. And this is very interesting. So for very big companies, this has now become somewhat mainstream. These are the firms that are currently factoring receivables according to public data. So CACI has a bank line of credit according to their 10K, but they don't. They factor receivables. Perspecta, according to their 10K, has a bank line of credit, but they factor receivables. CSRA have factored receivables. In fact, if you cover the C and you have SRA was our firm's client, Republic Capital Access, years ago, and also was CSRA. These other firms are more commercial oriented, AT&T, Sprint, Harley-Davidson, Cardinal Health, they all factor receivables. So typically in the non-bank finance market, we have a definition issue of, factoring or asset-based lending. Either way, with both scenarios, you're going to get access to liquidity that's going to be probably over and above what a bank is for a period of time for a kind of a small up and coming government contractor or one that's experiencing hypergrowth. So that's what all those firms have in common. They sell or factor their receivables. So this is the best problem to solve in GovCon. I spend most of my time here because this is the issue that we run into most often. And this issue comes across in a variety of questions, but basically the summation is, I'm going from 5 employees to 20. I'm going from 0 to 12. I'm going from 30 to 320. I am growing really quickly, or I'm adding 10 employees every month off new contracts or subcase to various firms. And so the synopsis is, does your growth fit? This is the hyper growth scenario. Only in government contracting can you experience exponential growth. So if you think about if everybody opened up a pizza shop in non-COVID-19 circumstances, you'd have maybe nice, steady organic growth, 3 to 5% a year. If you open up a dry cleaners, you're going to have nice, steady growth. This is the only market where you can go, I started my company in 2019, I had 10 employees, and now I want a contract, I'm going to 50. That doesn't happen in other industries. It really only happens in government contracting. And this sort of exponential and explosive growth is very hard for the traditional financing market to fund. So here's a case study of a company that we funded years ago. It's a company in Tennessee. They won a large services contract, and it increased their revenue by 4 times, up to $45 million a year. And so show me the non-government contracting company that this happens. This doesn't happen. And if you're in GovCon, we all know companies that have experienced this sort of growth at times. And funding this growth is exceptionally challenging. So in this instance, we gave them a letter of financial capability to show the contracting officer during the down select that they could actually perform on their work. So as a small business, some of you may be brought to, especially if you're in the 8A world, we see it more often than not. But the contracting officer wants to know, if I award you this contract where maybe technically you're proficient, can you actually pay the payrolls that are associated with this? Because this is substantial growth. So we provided the letter of financial capability with no cost or no strings attached to the firm. They gave it, they won it. And then we gave them a $5 million line to make payroll. I'm going to show you kind of the payroll cash flow invoice cycle in a second. We funded that in 2 weeks, and now is adjacent to their small bank line. So they kept the bank line of about $200K, and then we came with our $5 million next to it. The key to funding this sort of hyper growth of what's called unbilled funding. So I'm actually going to show this in a picture, and then we'll come back to the slide. So unbilled or mobilization funding, it's called a lot of different things. But if we look at this picture at the bottom, this is the issue that we are trying to solve. So you have work start on day 1, and then you have your first invoice at the end of that beige period, and then you have your invoice. Everything to the left of the invoice, so we'll put the invoice there. There's our little invoice there, a little $100 invoice to the government. Everything to the left of this invoice is unbilled or mobilization financing. That sort of funding, and I mean to the left, is you have a need for funding for payroll or operating expenses before you get to the invoice. That funding is not what the traditional bank market wants to fund. That's not what they're good at. What the bank market is good at funding is funding your invoices. So you have a $100 invoice, the loan against it. That's the blue funding. The beige funding is out of the bank box. Your now growth doesn't fit. You've grown too fast. You're too successful for a bank at this juncture. So what an unbilled or mobilization financing will do is it's going to address the timing relationships, the timing issue that you have. And this will advance in our program, 80% of earned and unbilled. Other programs are very similar that are out there. If you're dealing with a non-government contract focused, non-bank financing firm, you're going to see that number be like 50%. And they just don't know the space very well. But you're going to get an earned and unbilled advance. So that's the $35 and the $35. And then you'll generate your $100 invoice, and then that will be paid subsequently sometime later. So the key to managing hypergrowth in GovCon is getting access to funds before you have an invoice. So in the services world, that's earned and unbilled funding, or mobilization financing, called a bunch of different things. And then you need the subsequent invoice financing. Now, there are scenarios where you don't need the mobilization, because this is a 60-day cash flow cycle that we have here. That's day 1, 30 days you bill, and then you get paid at the blue, another 30 days. That's 60 days. It may be where a firm, you don't need the mobilization unbilled, but your invoices are going up $50 every month and your bank says, whoa, we're just growing too fast. So that's on the services side of the business, that is the type of funding you need. If you're not in the services business, then what you may need is purchase order funding. So purchase order funding is very similar, but it's very specific to product-oriented companies. So if we look at this little chart here, I'm a big believer in pictures make the world easier to understand. So if you're in the VAR space, if we look at Q4 of the government fiscal year end, 60% of dollars are going to be spent on products. So we are talking to a lot of product companies right now. And typically PO financing is meant to get orders processed when you don't have vendor credit. So what's vendor credit? Vendor credit is, hey, we'll ship you that product. Pay us in 30 days from now. That's great. You don't need financing to get the product shipped. You build a government, they pay you in 29 days or 15 days, hopefully, and you turn around, you pay your bills, and you don't need any financing. But now you come to a scenario where say, hey, we got a $500,000 order for this widget to go to SOCOM, and we need to pay for it before there's actually an invoice. So what does that timeline look like? So on the left here, you have your purchase order, you have funds advanced, and you go buy the product. So now you need to work with two types of companies. You need a PO finance company and you need an invoice company. So your PO financing firm, if we look at the cost of capital here, they're going to give you a rate of say X to go buy your product. They're going to ship it to GE to ship your whatever it is, generator or someone, whatever you're selling. And they're going to give you the money to go buy that product up front. Now you're going to bill the government. And an AR financing company will come in and finance our little invoice here. And once you're now into AR financing, you see your rate goes down and government pays the invoice. So you want to have an experienced purchase order finance company. Now, PO finance has all of a sudden been very exciting in the non-bank world because of PPEs. So personal protective equipment. This has been a lot of companies have gone after PPE orders, either direct to the federal government, to states, municipalities, hospital systems. There is a lack of PPE out there, and some people felt like they had an angle on it. Well, in a highly demand world of PPEs, N95 masks, we probably looked at about 40 to 50 different PPE deals. Every one of the manufacturers or suppliers wanted some sort of upfront payment or certified letter of credit, and that would only be supplied through a purchase order finance company. And that's how, if you read any of the articles about small contractors or companies executing on PPE deals, they did it with purchase order financing. It's not what the bank market does. What does a good PO finance partner do for a company though? It gives you a resource that intimately understands how the government accepts physical goods. So we worked with a firm in the purchase order finance company said, listen, before we outlay capital, you got to have this manufacturer has to be FDA certified. You have to have certain requirements on the mask and inspections. And they knew all that. And our client didn't know it up front, but ended up getting there because of the expertise of the PO firm. We did a PO deal years ago where we were the AR finance company. We had a client that wanted to deliver a large quantity of salt in the winter to a Midwestern state, which is a pretty reasonable thing to do on a barge. And it just so happened that the PO firm said, this is great, good company, we're super excited. You need insurance in case the rivers freeze and your salt can't get there on time. My client never thought of that. But when you're working with someone who has done these sort of deals over and over again, an expert in PO financing or delivering product will save you time, energy, and headache. But this is, take the giant step back. If you're in the product business, you need funds before an invoice. The PO financing will be the way to get there. I'm going to pause there and see if there's any questions. And if Brian, if you see them, just read them out loud. This is the, on the services side and the product side, the best way to ramp up. I'm going to go into how to fund a joint venture, which is very common in GovCon, but I want to pause here and make sure that there's no questions on this section.
No, I don't see anything as of right now.
Okay.
So good.
All right. Moving forward, joint ventures. So joint ventures are now becoming very popular. I'd say one out of every two companies we talk to has a JV, has a bid in a JV. They are looking at getting in a JV. They're doing something with the JV. So we've been funding probably a JV every other month for the last few months. So this particular JV was an SDVOSB. They won a $6 million a year contract to the State Department, and we gave a line to the JV. We increased the line to $900,000 when they won a new contract a little bit later. And because of our structure, both of the parent companies maintain their bank lines separately, and we just gave financing only to the joint venture. And some of you are probably thinking, why did you give financing only to the joint venture? It's because joint ventures, while very good for winning contracts, are a very convoluted financing vehicle. So I'm going to skip. Let's talk a little bit about, let's go back to this slide. I'll come right back to this slide, but I want to show pictures. So here's the issue with JVs. So we have the JV. So you have parent company A, parent company B, and you guys come together to create this JV entity. And this JV entity has all sorts of horrible credit characteristics. You have no equity, no employees, cash is distributed to the members, and it has no infrastructure, but you have this thing out of the contract and receivables. So what happens is one of the two companies, typically a small, one is big. So let's take this example. Company A is a minority company. They're the majority owner. It's a minority-owned small business that does $1 million a year. Company B, they know them for a while. They're good friends with the CEO. They do $100 million a year, and they got cash coming out their ears. But company A is majority owner. It's going to do 51% of the work. Company A is looking for financing. So they're looking at, now we'll go back, come back to the picture. So they're looking at, I need to get financing. And the parent company, or the larger firm with $100 million in revenue, they don't want to personal guarantee the financing for the small. That's not equal member risk. There's not skin in the game for them. So there's no personal guarantees. This is why it's a good fit. There's no capital contribution. So no one's asking for the $100 million company to put in, say, $1 million of equity to put for a line. And there's no covenant. So there's no oversight constraints on any of the firms. So what happens is, how are you going to fund this new contract to the $6 million contract, $500,000 a year? So parent company A and B, company A is like, hey, we need cash. Do we have enough equity? And they go, no, we don't have enough equity. Company B goes, well, we're not putting our equity into the JV that you have 51% ownership in. That's really mostly your work share. This is too complicated, too legalistic for us. And then company A goes to their bank, hey, will you fund my receivables? Because remember, parent company A is a subcontractor. Can you fund my receivables to the joint venture? Even though the joint venture doesn't have any collateral or infrastructure or cash or anything like that. Typically, the bank says no. Company B really doesn't care because they just have cash to float it. And their bank may say, you know what, this is 2% of your overall revenue. That's fine. But company A, this is their concentration. Like all their revenue is from the JV. Then what happens is parent company A goes, well, we'll personally guarantee it. And the bank goes, not enough. You don't have a big enough guarantee. The bigger firm B, they don't want to guarantee it because now they feel like they're unequal risk here. And then do you have enough cash to fund it? Company B is not going to float cash. Company A doesn't have enough cash. So here's the issue. You have 2 payrolls you need to cover, and then 2 more payrolls. So day 1 through 30, work is going on. That's your first 2 payrolls. And then day 31 through 60, you have 2 more payrolls to cover. So as we said, we've eliminated all these typical financing options. And sometimes you'll see a bank get involved, but typically it's been more challenging, especially now with everything going on with COVID. Banks are looking to de-risk. So what we'll do is we'll actually buy the JV receivable, and then the JV can distribute the funds to parent company A and B. And it makes a very clean solution because parent company A they now have access to the capital they didn't have before, but they're not asking the larger firm that helped them win the contract. They don't have to guarantee the financing. They don't have to put cash in. They don't have to use their bank line. It's very clean for the parent entity. And each member there's no risk. And so it is an equal risk share. but it allows a JV to get access to the capital at typically a rate that's a little more than a bank, but much easier to obtain. When you're looking at financing options in the bank market, just a few kind of things to look out for. You need to ask for client and former client referrals, a transparent term sheets, an industry specialist with experience in GovCon. A lot of firms say they do GovCon, but they're not good at doing it. You want to have a diversity of funding sources. So if you have AR financing and you're going to bring in sub-debt or equity or PO financing, are they going to be flexible? There should be no minimum terms or termination fees. You should have unlimited growth capacity. So you never know when that big contract's going to win. And watch out for bundled services. So, you know, if a firm's going to sell you payroll financing and insurance and payroll processing, that's bundled services, you're better off getting that broken off by, you know, having a firm like Brian's doing your insurance, a payroll provider, and then financing. It's not Verizon. The triple play is not going to save you money. It's actually going to increase your cost in this market. All right, so Brian mentioned smoking earlier, so let's talk a little about how we can make a good rib recipe. So here is my best rib recipe that I know, and we'll jump back in and wrap this up. So I love cooking ribs. I have a big green egg. If you're interested, it's 250 degrees. I use apple wood. I basted hours 2, 3, and 4 with apple juice and a little bit of apple cider vinegar, and you can throw in a little bit of barbecue sauce. And you pull at around an internal temperature of 195, which is about 4 hours. And this was my last cook. So we probably won't get any questions on financing, but probably some questions on how we can best make ribs at home during isolation and quarantine. All right, we're going to rip through these a little bit faster because most of these statistically so you guys are going to be more in a non-bank space on average and then transition from non-bank to bank. But some of these types you're going to hear out there in the market, and it's good to kind of know what it is. So mezzanine financing, it's like the mezzanine level at a hotel. It's in the middle. So if you look at the capital structure picture, you have your senior secured, that's like AR or equipment. And at the bottom you have equity. And mezzanine is the sandwich. It's in the middle. It's the middle level of the hotel. So they're junior or subordinate to the sub-debt. So it's not as secured as senior, but not as unsecured as equity where you could lose everything, although you could lose your entire investment. So all mezzanine is, it's in the middle between your senior lenders and your equity. It's in the middle. So mezzanine financing, is typically 12 to 20%. And these are for really good companies. So don't get hung up in low interest rate environments. Rate is immaterial to access to capital to grow your firm because your margins are always going to be better. So if you take a mezzanine loan and pay a 12% APR rate, and then you win 2 massive new contracts, your company is infinitely more valuable. And it's typically reserved for companies that have a track record of profitability. Very common in private equity owned groups. And you can sometimes defer. These are used in GovCon with ESOPs, which were the rage a couple of years ago. Quickly growing companies may have this to augment their senior financing that are looking to sell in 3 to 5 years. And this is typically M&A transactions or M&A with private equity groups use it a lot. You'll hear the term, if you get involved with mezzanine financing, warrants. So a warrant is simply someone wants the upside of your stock price to make a partnership in the deal. So let's say your stock is valued at $10 a share. You take on the mezzanine financing and your stock price on evaluation goes from $10 a share to $15. They may get exposure of that $5 increase for 20% of your stock. So they're not true equity owners, but they're getting an equity upside. Most firms that provide mezzanine financing want to be out in 2 to 3 years. Here's a good structure of where mezzanine financing is used. So let's say a private equity group is going to buy a government contractor for $100 million. And this is kind of like buying your home. You want to put as little cash in the kitty as you can or down payment. So they go in 10 million of equity. They get a senior bank facility to do 70 million. And to bridge that gap would be 20 million of mezzanine financing. So your bank loan, say that's at 6%, mezzanine comes in at 12, and then the equity is 10. And that's a good use of mezzanine financing. It kind of bridges the gap, if you will. But it's very common. There's a lot of small boutique private equity firms in the DC, Baltimore kind of market, and it is a significant tool that they utilize. MCA or fintech loans. So let's see where they are in the chart. Very expensive and easy to obtain. Fast, cheap, and good is how you get all things in life. And money is no different. So if you're going to get money fast and it's going to be real American money, it's not going to be cheap. And this is where this comes into. And I'd also call this the Dr. Google of financing. And if you're looking for financing on the internet, it's going to be really expensive. So MCA loans, if you Google like fast cash, this is typically the stuff that comes up. It's online fast funding. It's over 20%. I've seen over 100% APR. It's structured as a term loan, but it's technically what they'll call it to get around usury laws, the purchase of future receivables, automatic debits from your bank account. It's typically tied to personal credit of an owner. There are some useful purposes. So this is not all bad, but you need to understand how to use it correctly. And this is the second option for working capital. This is maybe the fifth option, but it is nonetheless a good option for working capital. So you need to understand how the interest rates in MCA loans are paid back. MCA loans are paid back in something that's called simple interest, not how your mortgage is structured. Your mortgage is structured in amortizing interest. So this is much different and significantly more expensive. So for example, you took a $10,000 loan, I tell you your simple interest will be 10%. You're like, wow, that's a great deal, 10%? Like, Matt, I thought you said this was going to be 20%. Well, simple interest means that's the amount that you're going to pay back. So you're going to pay back $11,000. But if you pay back $11,000 in 6 months, that's 20%. And if you pay it off early, you will have a prepayment discount. And as you get into longer time periods, that interest payment gets higher. Typically, what you'll hear is interest. They'll call it a factor rate. They'll say like it's a 1.35 factor rate, which is really 35% of whenever it's paid back. Different than your mortgage rate, where you only pay interest on the outstanding amount at one point in time. You pay it. Your interest is almost pre-baked into the loan, so it's a much higher interest rate. So here's some decent uses or good uses of an MCA loan. Providing an advance without collateral. So if you have, say, 100 in AR and you have a $100 million line of credit or $100,000 line of credit, and you need to hire a new BD person or make a lease payment, and you have a small bank line of credit, you just need money to hire people. You have the cash flow to pay it back. You've modeled it out. But you just need the cash. You don't have a HELOC personally. You don't want to take a loan from your 401k. Not the worst use of an MCA loan, but that is to a well planned out, thought out plan. Second good use, you have $100,000 in AR, but you are underwater at your bank. So you have a $150,000 loan from your bank and you need to exit to get in a more flexible relationship. The MCA lender could provide that $50K to get to a non-bank lender so you get more liquidity. So you're using it to restructure, and you're considering doing this because you're possibly winning new contracts that your bank can't fund. Possibly a good use. But here's all the other options that you may want to explore first. Most MCAs will work adjacent to a non-bank lender financing company. So you'd want to go through the non-bank AR type financing decision tree first, like we discussed earlier. You may want to eliminate business expenses that would be not otherwise incurred. So if your G&A is really high, don't use an MCA loan to float that. That is probably not the best use. You should look at that. If you start stacking loans, you are putting yourself way behind the curve. So most finance and banks now, if you have more than one MCA loan, it may be an automatic decline before you even tell them your story. So don't look at stacking the loan. Don't cover losses by excessive G&A. An MCA loan because you have poor planning, because you thought that a bank would come through for you, and you have payroll to cover, run multiple paths, run a parallel path. This is a last resort option, and if poor planning leads to it, it could put your business in jeopardy. Don't use it for PO financing unless you've been declined, and this is the last resort option. So this is the way down at the bottom of the list. It is certainly a tool, but it's a tool that after you've exhausted several options, you need to, would be reasonable to look at. And the last bit on this is you need to remember how term loans are, how these are paid back. They're paid back through profits. So if you are going to pay back a 50K MCA loan over that period of time, say 12 months, you're going to make 50K in profit. It's not like working capital where you pay back through the churn of receivables. You hardly ever see it. This is like, you know, when you pay your mortgage, when the Stavish family pays their mortgage, that comes out of your basically profitability of your paycheck every month. It's very similar. So it's a much different payback cycle from your cash flow perspective. All right, so equity. And then we'll kind of wrap this up here and see if there's any questions. So there are two types of equity. Government contractors, you're pretty savvy about this. They understand that they have like an A to A business. You can maybe give up 49%, but you need, or STVOSB, you need to be cognizant of founders with set-aside statuses. The awesome thing about GovCon is that you can totally bootstrap your business, and you don't really need to raise equity. I can't tell you how many of my clients start off by billing themselves and then add 10 people, and then they come off billing full time. But family and friends, but because owners in GovCon can be billable from the onset, that covers so many of your operating expenses and allows for greater profitability. This is why GovCon is such a great avenue to start up a firm, because you can be billable yourself for a significant period of time while you build up workers to augment your G&A until you can become off billable work. Most GovCons are not, though, what a venture equity firm are going to look to invest in. And this is why the government has programs. Brian brought this up. They're going to do something on OTAs later. Other transaction authorities, InQtel, which is the CIA's kind of private equity arm, and SBIR programs. This is the government's way of being a venture equity. They're going to take the product risk because the government sales cycle is too long. Now, if you're a founder and you have a lot of significant venture angel funding, like, you could potentially get this sort of money. But typically, this is not what venture equity firms are looking to invest. And that's why there are OTA programs. So with the government, the key for equity, if you're a GovCon thinking about, I'm going to get some equity, is that most angel and venture investors are willing to take market risk, not product risk. Well, if your market is only the government, right, then if your product is not bought by them, there's no other market risk to take. So is your government product going to be commercially viable? The government will take product risk. So this is what's great for GovCon. If you have a great idea, the government may fund your product development, which is fantastic, and no other space is that possible. And then you could sell it right back to the government. Now, if you have a product that has a proven commercial appeal and you want to move from, say, I'm selling to DOD and I could also sell this to these other folks, then you have venture money interested, because they go, okay, you have a product. I now want to take the market risk over here. And there are firms out there that will do that. I did a webinar down for University of Central Florida. They have an incubator, and that's exactly what some of the private equity groups do. Is they want to take, you have an OTA SBIR program, you have a product that was developed, what's the commercial applicability of that product, and they'll invest in you to help take that to the commercial market space. All right, so R&D grants. So obviously equity, just getting back to our chart, it's hard to obtain, it's very expensive, it's the most expensive form of capital out there. R&D grants and OTAs are very cheap money, because it's basically they're taking the product risk, but you got to have a really unique product. So it is hard to obtain. And that's what InQtel does. I'm not going to go into what they do. I think Brian's going to cover this later, but that's what InQtel does. That's going to be your other transaction authorities. Are you going through a consortium, through a competitive procurement process? Sometimes there's just small areas of expertise. So you may get an OTA award direct to your firm. I work with clients that have OTA awards. I work with consortiums that have been our clients, kind of all over the map. That market is unique, and that will be a good webinar I'll log into when Brian has that later this summer. And typically, those are only DOD, reserved for DOD. The company we financed that had the OTA award, it's really interesting. If you've seen a government contract that has like 31 different blocks on it, those contracts are written in Microsoft Word. It's unique. And then you have the SBIR programs, which if you're applying through SBIRs to solve a problem, that's another good way to obtain equity, to build your product. And then if the government may take your product and buy it, or you could sell it to the commercial markets. Skip through this. So that is the financing market. Those are the general things that are out there. It's a broad market. Most GovCons are on this call are going to be in the non-bank to bank or bank to non-bank. And you may go back and forth between bank and non-bank. You know, you're with non-bank, you grow, you're steady. You go to a bank, you grow really fast, you come back to a non-bank. And that's very normal. And then depending on what you do, you may slide and do mezzanine with a private equity group, take equity, may start R&D, but all of you are going to bounce around between these bubbles at some time in your life cycle. And that is my contact information, same as it was earlier. And if there's any questions, I'll let Brian queue it up. I don't know if I can pull up the Q&A bar here.
I don't see anything at the moment, but I do have a question, and it really, I was taking notes throughout, and it kind of came at the end as I was looking at the financing market. So I guess with a little bit of a leader, ultimately the question is about, you know, how do you make sense of this, right? So, you know, I learned a good bit just by, you know, our pre-calls on this, and then even more throughout the course of this, you know, 45 minutes or so. But a lot of GovCons, in my experience, it's like you just said, it's you have an owner that, you know, has done really good work for a customer, and the customer says, hey, I'd like to have you come in and do this for me, you know, form your own company, whatever. They make this decision, they step out, and then it's kind of like they have a chip in a chair, right, to play the game. And they're kind of in the mix, and they're starting to grow organically, but it's a billable senior exec, CEO, president, founder. And when I look at this chart, I'm like, well, how do they know where to go, when to go? Because typically they're not going to have a finance person that's there. They're not going to have a director of finance or a CFO until they're much, much larger. They just don't make that. They don't spend the money on that because it's not they don't have the overhead to be able to do so. Mm-hmm. So how do they make sense? Like when you're looking at this, because I would imagine if I talk to a banker's going to talk about what they can do and what they can't do, and they're not going to probably talk about these other bubbles so much. So, you know, how do you get yourself to understand? How do you bring an advisor in, or have somebody that can kind of give you the lay of the landscape on this?
Yeah. So typically, what will happen is, so let's say you start up a company and you win a contract. You're going to go walk in to pick a bank that does GovCon in the area, in the DC metro area. And you're going to start at the bank bubble, at least as far as you're walking their office. And I just had this happen last week. They talked to a banker that does a lot of GovCon. And he goes, you're a startup, but this is a totally fundable contract. You should talk to Republic. So you talk to the bank says you're going to be non-bank. I talked to him, said, hey, yeah, you're probably going to be with us for about a year. And then you're going to graduate, if you will, from non-bank financing to a bank financing. And then from there, if you eliminate the MCA loan bucket for a while, as the company grows and you add a controller, and you're going to just be using bank financing. But as a company gets more sophisticated and bigger, you're going to then hire maybe a CFO that has a lot of experience in this. And let's say you go now, you're 30 million in revenue. You guys have a real expertise, top secret security clearance. And, you know, there's a technology that you developed that's very interesting. And maybe a private equity group is interested in taking a minority position. And because of your relationships of your CFO that you hired, and you're working with people that are experts in this space, you get enough conversations where you then take an equity piece. And then those people lead you to, hey, we could do this and this. We could buy this company over here with equity plus mezzanine. So typically, a company will naturally go through a company that's really growing is naturally going to move through these life cycles and hit these different bubbles by just the experts that they're working with in their field. But this all starts one of two ways. Either you go and you talk to a real banker that knows government contracting, and they're going to either they can finance you or not. And that's going to lead you to them, or you're going to be referred to someone like us in a non-bank space that's going to fund you. And you're going to go back and forth until your growth, like I just referred a client of mine to a private equity group. So depending on who you're working with, if they're experts in their field for government contracting, you're going to eventually hit all of these bubbles. And you're eventually going to get to the point when you're going to hire a sophisticated CFO or get consulting that's going to refer you to these other folks. And typically, like for the R&D grants and SIVR stuff, Brian, The owner knows about those, and no one needs to explain it because that's a very technical person. That's usually a PhD in the CEO spot, and they started their company because they know the SIVR program so well. So to answer your question, it always starts typically at the bank level. And then from there, you kind of get introduced to the right people, you network your way, and eventually you'll touch these buckets.
What are the characteristics then? So it's probably one of those things that, you start off, you make sure you have your corporation established, and you start getting your right advisors. You go to a bank because you need some assistance. When you're looking at, in that bank bucket to start with, you mentioned, a bank that understands GovCon. What are the characteristics that you typically see? I mean, obviously there's like big companies like Bank of America, or there's a PNC and these other types of companies. Then there's community banks, and then there's others that kind of fall in between there. What are the characteristics that you would find in a bank, and how would you find that right?
Yeah, I think it's a good question. I think, you got to use the sniff test. This is you can pretty easily understand if someone knows government contracting when you start talking in acronym-based sentences and they're following along and they can regurgitate it back to you.
Yeah.
What I have found is that if you go to pick a big bank, most big banks have a GovCon specific group. So let's say over $10 million in annual revenue in your government contract, you're going to be in a specific group working with a banker that does primarily government contractors, and they're going to understand you. If you're below that, you're going to be in the business banking group, and they're going to probably have a couple people that understand GovCon. And if your banker doesn't, then that's a good sign to say, hey, is there someone in your bank that understands my market a little bit better? Because it seems like that all of your clients are, residential, commercial real estate, which is great. Sounds awesome, but not what I do. And the same thing goes with community banks. Most community banks have a dedicated GovCon or commercial and industrial lending team, C&I lending team. And they're going to understand your market, and they're going to also have real estate bankers. But most banks are pretty good at ferrying you to the right point of contact initially. If you walk into some of these banks that have branches and you're talking to a branch manager to open up an account, you probably want to ask, is there a government contract lending specialist or business banker that does a lot of GovCon lending for me to start to have this conversation with? Unfortunately, banks' websites aren't so well populated that they have bankers' email addresses and their expertise on their website. To that end, I introduce bankers to companies all the time. So if someone on this call is needing to talk to a GovCon banker, I can introduce you to a small, medium, and large bank and kind of see where the best fit would be. But you got to kind of network your way and ask the right questions. And if you don't think that the person you're talking to in the DC metro market, there's a lot of GovCon bankers. If they don't understand your business and they don't know what an SDVOS BJV is, it's going after, T4 Next Gen. If that's whoa, that's blowing their mind, and stop and talk to someone else.
Unfortunately, I understood everything that you just said. And I used to be in that business. So. I don't see that we have any questions. I think that's because you're fairly thorough. So I appreciate that. So we're coming up on an hour. And there is a survey that's going to pop up. So we'd appreciate it if you could complete that. I've got another event coming up in a couple of weeks. It's more HR focused with an HR consultant on, it's called Part 2, Selection and Onboarding. So if you have somebody in your firm, it's probably not you that are attending this one, just because they're kind of different disciplines. But if you have an interest in that, certainly you can register. With that, I'd like to thank you all for your attendance and engagement. And Matt, thanks for your energy, enthusiasm, and expertise. I got a good bit out of this session, and hope that the attendees did as well. I will follow up via email and connect you. I know Matt's provided his contact information here, but I will do an active connect where you'll see his email address in an email, and you can reach out to him directly. Not to put you on the spot, but I'm assuming, Matt, that if necessary, you're happy to be that connector, right? Just to have a conversation with somebody if they have questions.
Most of our job is connecting people on deals that we are never going to be active in, but we're just getting people to the right spot. And when we say, hey, let us connect you, and it's a small world out there.
Yeah, we were very, very similar. Right? And then this will be up as well This video will be up on my fledgling YouTube webinar station, which it'll be out there in the next probably 24 to 48 hours, just depends on how long it takes me to get it uploaded. And it'll be on my LinkedIn, so you can see it there. If you have a reference somebody in your organization that you'd like to see this, they can catch it there as well. With that, Matt, I'll give you the last word. I'm all done for the day. Thanks so much.
Thanks, everybody. Good luck in the government fiscal fourth quarter.
Yeah.